Ladies and gentlemen, let me be brutally honest with you. Because the market doesn't care about your feelings, right now real estate is flashing warning signs, and most people are ignoring them. That's a mistake, an expensive one. Cheap money created a fantasy. Prices soared, leverage exploded, and everyone thought real estate only goes up. But I built fortunes and avoided disasters by watching one thing: cash flow and risk. And today, the math is breaking, interest rates are up, buyers are disappearing, debt is getting crushed. And when fundamentals collide with reality, bubbles don't deflate gently, they pop. This is not about fear, this is about preparation. Because when markets reset, smart investors don't panic. They position themselves to win. So listen carefully. The real estate party is ending, and those who understand what's coming next will protect their capital and maybe even make a fortune while others lose theirs. Let's talk about the truth, starting now. Interest rates are killing affordability because real estate lives and dies on the cost of money, not on optimism or Instagram headlines. When rates were near zero, buyers could borrow cheaply, stretch their budgets, and convince themselves that any price made sense. That era is over. Every percentage point increase in interest rates slashes purchasing power, and the market is finally being forced to respect math again. A buyer who could afford $1 million property 2 years ago often can't touch the same home today, even if prices haven't moved. Monthly payments have exploded, not because homes improved, but because debt became expensive. Real estate is leveraged by nature, and when leverage costs more, demand collapses quietly at first. Then suddenly, sellers are still anchored to yesterday's prices, but buyers are anchored to today's payments. That gap is where markets break. You can't will affordability into existence, and you can't talk your way around a mortgage rate. Banks don't care about narratives. They care about debt service ratios, income, and ROI, and those numbers are tightening fast. Investors feel this pressure even more aggressively. Cap rates that once looked acceptable no longer clear the cost of capital. Deals that almost worked are now dead on arrival. Refinancing has turned from routine to brutal, and anyone who assumed low rates were permanent made a dangerous assumption. This is how bubbles form and how they unwind. Risen. G rates don't just slow activity, they expose weakness. Highly leveraged buyers get trapped. Variable rate borrowers get crushed. Developers discover that projects penciled on cheap money don't survive reality. Affordability isn't a social issue in this context. It's a financial constraint, and constraints always win. Governments can talk about housing shortages, incentives, and support programs, but none of that overrides the bond market. When inflation is a threat, rates stay higher for longer, and real estate must reprice to survive in that environment. History shows this pattern repeatedly, and pretending this time is different is how capital gets destroyed. Smart money is already adjusting. They're holding cash, demanding higher yields, and refusing to chase deals that don't compend. Sate for risk. The days of buying anything and waiting are gone. Affordability has become the gatekeeper, and it is closing fast. This shift changes behavior across the entire ecosystem. Appraisals come in lower. Lenders demand more equity. Buyers hesitate longer. Time on market stretches. Price reductions become normal again. Psychology flips from fear of missing out to fear of overpaying. That transition is slow, then fast, and once it starts, it rarely reverses until affordability and income reconnect in a way that makes sense for the average participant operating under current wages, current rates, and current risk tolerance. Across residential and investment markets, cash flow matters more than hype, because hype doesn't pay the mortgage, the taxes, the insurance, or the debt. Hype is emotional, cash flow is mathematical, and markets always choose math. When money was cheap, investors ignored fundamentals and told themselves appreciation would solve everything. That logic only works in a fantasy environment where rates stay low forever and prices never correct, and neither of those conditions exist anymore. Real estate is not a lottery ticket, it's a business. Businesses survive on income exceeding expenses. When a property doesn't generate positive cash flow, it becomes a liability disguised as an asset. For years, investors accepted negative cash flow because they believed price growth would bail them out later. That belief was fueled by social media, podcasts, and self-proclaimed gurus selling dreams instead of balance sheets. Once interest rates rise, hype evaporates instantly. Appreciation slows, then stops, and suddenly the only thing that matters is whether the asset can stand on its own. If rent doesn't cover debt service, the owner starts bleeding every month. That bleed might be manageable for a while, but eventually reality shows up in the form of stress, forced sales, or defaults. Cash flow gives you options. It gives you patience. It gives you survive. An investor with positive cash flow can wait out volatility, negotiate better terms, and ignore panic. An investor relying on appreciation is gambling on timing, sentiment, and someone else paying more tomorrow than they did today. That's not investing. That's speculation. In tightening markets, lenders suddenly rediscover discipline. They stop lending on stories and start lending on income. Properties that once looked impressive on paper fail underwriting tests because the numbers don't support the debt. That's when hype-driven valuations collapse. Cap rates expand, prices adjust downward, and only assets producing real income retain value. Cash flow also protects you psychologically. When markets turn, fear spreads faster than logic. If your asset pays you every month, you don't paw. If it drains your account, every headline feels like a threat. Emotional decisions destroy wealth faster than bad markets, and cash flow acts as a stabilizer against irrational behavior. Experienced investors always return to the same question: does this asset pay me enough to justify the risk? Not will it look good online, not will someone admire it, not will it double in 5 years. Income. Durability and margin of safety are what separate professionals from amateurs. When hype leaves the room, discipline walks back in. Rents become real again. Expenses matter again. Vacancy assumptions get conservative. Management quality becomes critical. Cash flow isn't exciting, but it's resilient. It's boring in the same way compound interest is boring, and that boredom is exactly why it were. Markets reward those who respect fundamentals and punish those who chase stories. Every cycle teaches the same lesson to a new generation of investors who believe they're smarter than history. Cash flow isn't optional, it's the foundation, and without it, everything else eventually collapses under pressure when conditions change and capital becomes selective. Again, leverage is turning from fuel to fire because debt amplifies reality in both directions, and most investors only plan for the upside. When prices were rising and interest rates were low, leverage looked brilliant. Borrowing magnified returns, made deals look smarter than they were, and rewarded speed over discipline. That environment trained people to believe that more debt meant more success, but leverage never changes its nature. It only changes who it punishes. In a rising market, leverage feels like gasoline on growth. In a tightening market, it becomes an accelerant for losses. The same borrowed money that boosted returns now magnifies stress. Higher rates increase debt service. Slower price growth removes the escape hatch. Suddenly, leverage stops working for you and starts working against you. Variable rate lower. NS are the first fault line. Payments reset upward, margins disappear, and owners who planned on refinancing find themselves locked out. Fixed-rate borrowers aren't immune either. When values fall, equity evaporates, loan-to-value ratios spike, and refinancing becomes impossible without injecting fresh capital. That's when leverage turns from a tool into a trap. Developers and speculative investo. RS are especially exposed. Projects financed on thin margins and optimistic exit prices break quickly when assumptions fail. Construction costs rise, absorption slows, and carrying costs climb every month. What looked like a temporary delay becomes a cash drain that doesn't stop. Leverage doesn't allow time for mistakes. It accelerates them. Banks understand this cycle well, which is why lending standards tighten when stress appears. Credit becomes selective, covenants get enforced, and extensions disappear. Borrowers who assumed flexibility discover that contracts matter most when conditions are worst. Leverage gives lenders control, and when markets turn, that control becomes very visible. Psychology shifts fast under leverage pressure. An unleveraged asset can wait. A heavily leveraged D1 cannot. Time becomes the enemy. Decisions get rushed, assets get sold at discounts, owners stop thinking strategically and start thinking about survival. This is how forced selling begins, not because people want to exit, but because leverage removes their ability to stay. Leverage also creates systemic risk. When too many participants are over-leveraged, individual problems become market PR. Problems: distressed sales reset comparable prices. Appraisals fall. Equity disappears across portfolios, even for disciplined owners. Leverage concentrates pain and spreads it outward. Smart investors use leverage cautiously, understanding that it's a multiplier, not a guarantee. They assume rates can rise, values can fall, and capital can disappear. They structure debt to survive worst-case scenario. OS, not best-case fantasies. Those who didn't are now discovering that leverage doesn't forgive optimism. Every cycle ends the same way. Debt that was easy becomes expensive. Assets that relied on leverage reprice downward. Those with too much borrowing are forced to act, and those with conservative structures gain negotiating power. Leverage never destroys markets by itself. It simply exposes to what depended on it to make a bad deal look good when conditions were artificial and forgiving rather than durable and grounded in sustainable financial reality. Speculation always ends the same way because it is built on belief rather than value, and belief is fragile under pressure. Speculators don't buy because an asset produces income or solves a real need. They buy because they expect someone else to pay more later. That logic works only as long as confidence keeps rising, and confidence is the first thing to disappear when conditions tighten. In real estate, speculation disguises itself as optimism. People convince themselves that price growth is guaranteed, that demand will always outpace supply, and that timing doesn't matter. They ignore fundamentals because the market rewards speed DU. Ring the boom phase. Early wins reinforce bad habits, and success built on luck gets mistaken for skill. Speculators often rely on short holding periods, minimal equity, and maximum leverage. They plan exits before they plan operations. When markets slow, those exits vanish. Listings sit, buyers hesitate, financing dries up. Suddenly, the only thing left is an asset that doesn't perform and can't be sold without taking a loss. This is where speculation collapses into reality. Carrying costs don't care about confidence. Taxes, interest, insurance, and maintenance continue regardless of sentiment. As holding periods extend, weak deals expose themselves. Owners who never intended to hold long-term find themselves trapped by an asset that was never meant to be sustainable. Speculation also distorts pricing across entire markets. When buyers are motivated by future resale instead of current utility, prices detach from income levels and rental yields. That distortion creates bubbles. Bubbles don't require fraud, they only require enough people to agree to suspend disbelief at the same time. When the turning point arrives, it rarely announces itself. Activity slows quietly. A few price cuts appear. Days on market increase. Then one forced sale resets expectations, and suddenly comparable values start falling. Speculators rush for the exits at the same time, and liquidity vanishes exactly when it's needed most. The emotional impact is severe because speculation ties identity to outcomes. When people buy into a story, they defend it aggressively, they dismiss warning signs, they attack anyone who challenges the narrative. That denial delays necessary action and deepens losses. Markets don't respond to confidence, they respond to transactions. Every cycle proves that speculation concentrates pain at the worst possible moment. Those who bought late paid peak prices and assumed quick exits absorb the losses that early participants already escaped. Wealth doesn't disappear. It transfers from those who chased momentum to those who waited for value. Regret always follows the same script. Speculators wish they had sold earlier, borrowed less, or analyzed more deeply. But the lesson is never about timing perfectly, it's about structure. Assets that depend on appreciation alone are fragile. Assets supported by income and utility can survive. Speculation isn't evil, it's just unforgiving. It rewards speed and punishes patience, then reverses without mercy. Those who confuse speculation with investing learn the difference only after conditions change, and the crowd realizes too late that stories don't hold value when money becomes expensive, and reality demands proof instead of promises. Liquidity is disappearing fast because markets only feel liquid when everyone wants to buy, and that illusion vanishes the moment uncertainty takes over. In strong markets, assets appear easy to sell, prices seem stable, and participants assume exits will always be available. That confidence is dangerous. Liquidity is not permanent, it's conditional, and the condition is confidence supported by cheap capital. When interest rates rise in credit H10s, buyers retreat first. They don't announce it loudly, they just stop making offers. Lenders slow approvals, investors wait for better pricing, and suddenly transactions drop. Liquidity doesn't disappear in a crash, it dries up before the crash, quietly and unevenly. Real estate depends heavily on financing, and financing depends on liquidity in the credit markets. When banks become cautious, loan terms change. Higher down payments, stricter underwriting, and lower appraisals reduce the buyer pool dramatically. Fewer qualified buyers means fewer transactions, and fewer transactions mean weaker price discovery. Sellers often misunderstand this phase. They believe their asset is still worth what it was last year because nothing has changed physically. But liquidity is about demand. No. Condition. A property is only worth what a ready, willing, and able buyer can pay today, not what someone paid yesterday with cheaper money. As liquidity contracts, bid-ask spreads widen. Buyers offer less, sellers ask more, deals fail to close. Time on market increases. That time becomes a signal. Long listings create doubt. Doubt reduces urgency, and urgency is essential for liquidity. Once urgency is gone, price reductions follow, but slowly because sellers resist accepting reality. Investors feel the squeeze more intensely. Illiquid markets punish leverage and speculation simultaneously. Those who need to sell quickly discover that speed requires concessions. Discounts grow larger the faster liquidity is required. This is where forced sellers define market bottoms, not rational PR. Icing models. Liquidity also affects valuations indirectly. Appraisers rely on comparable sales, but when sales decline, comps become outdated or irrelevant. That uncertainty makes lenders more conservative. Conservative lending further reduces buyer activity. It's a feedback loop that feeds on itself until prices adjust enough to restore confidence. Psychologically, illiquidity changes behavior. Buyers gain power, sellers lose it. Negotiations become asymmetric. Terms matter more than price. Cash becomes dominant because it removes financing risk. Those holding liquidity gain optionality while others are constrained by timelines and obligations. Markets don't crash because everyone wants to sell. They crash because no one wants to buy at previous prices. Liquidity is the invisible screw. Feature holding markets together, and when it weakens, even strong assets feel pressure. This is why experienced investors track transaction volume more closely than headlines. Liquidity returns only when pricing reflects new realities. Until then, assets sit, capital waits, and expectations reset. The process is uncomfortable because it exposes assumptions that were never tested under stress. Liquidity doesn't disappear forever, but it always disappears faster than people expect, especially in markets built on leverage, optimism, and the belief that exits are guaranteed rather than earned through fundamentals. And disciplined pricing and changing financial conditions crashes create millionaires because every market reset destroys illusions and rewards discipline, preparation, and patience. Wealth isn't made when everyone is optimistic and prices are soaring. It's made when fear dominates, valuations collapse, and most participants are desperate to sell. History shows this pattern repeatedly. The same people who thrived during crashes were rarely the ones who bought at the peak, leveraged excessively, or followed the crowd blindly. During booms, participants often confuse activity with opportunity. Properties trade rapidly, values climb, and headlines celebrate every new high. Speculators and emotional buyers flood in, driven by fear of missing out rather than careful analysis. In those moments, wealth creation is theoretical, dependent on someone else paying more tomorrow. True wealth is not built on hope, it's built on reality, and reality shows up first in downturns. When the market turns, chaos forces clarity. Over-leveraged owners who relied on constant appreciation are exposed. Distressed sales flood the market, creating temporary imbalances between supply and demand. Prices adjust downward sharply, often overshooting fair value. In that window, the prepared investor sees opportunity where others see panic. They have liquidity, they have patience, and they have courage to act when most are paralyzed by fear. Crashes also recalibrate fundamentals. Cap rates normalize, rents reassert their importance, and properties that generate real income stand out. Assets that were previously overpriced suddenly become bargains. Savvy investors can acquire cash-flowing properties at discounts that would have been unimaginable during the boom. Those who understood value all along can now leverage lower prices to maximize returns, essentially compounding gains that others lost to fear and miscalculation. Access to capital during downturns is another differentiator. Investors who conserved cash, avoided excessive leverage, and focused on liquidity gain a strategic advantage. Sellers facing distress are often willing to negotiate terms, offer financing, or accept lower prices. The imbalance between motivated sellers and prepared buyers is where fortunes are made, and this is rarely visible until the panic begins. Crashes also teach lessons that markets and expansion never do. Risk becomes real. Assumptions are tested. Strategies that relied on optimism or momentum fail, while those based on income fundamentals and prudence survive. Experience gained during downturns compounds with future opportunities, giving disciplined investors a structural advantage over those who never learned the pain of loss. Another critical aspect is timing and patience. Many people believe crashes are about immediate buying or selling, but wealth creation depends on identifying the right assets, structuring deals correctly, and holding through. Recovery. Hasty decisions during panic often destroy capital, while thoughtful strategic action multiplies it. Crashes are the ultimate filter, separating reckless participants from disciplined investors. Psychology plays a huge role. When others panic, courage is rewarded. When desperation drives the market, opportunity arises. Crashes reward those who detach emotionally, think analytically, and execute decisively. Wealth built in downturns is durable because it is earned under conditions of stress, scarcity, and real competition, rather than riding the wave of collective enthusiasm and borrowed optimism that defines boom periods. Crashes are the great equalizer in markets. They punish overconfidence, expose risk, and strip away illusions. But for those who prepare, understand fundamentals, and act strategically, they are the most fertile ground for creating lasting wealth and seizing positions that would have been unattainable during euphoric times.